Mainstream economics models the welfare state as a unilateral fiscal liability. In this orthodox view, age pensions, unemployment benefits, and rental assistance are passive charitable drains on the public treasury, requiring future taxation or debt to balance the national ledger. But this narrative relies on a mechanical flaw. It assumes the public deficit and private profit are isolated events. In reality, these two ledgers are structurally linked by an immediate, highly efficient transfer of capital. The welfare state operates as an active, high-velocity, indirect moral micro-subsidy. The state injects fiat currency at the base of the economic pyramid, utilizing vulnerable citizens as biological conduits. Because these individuals must secure food and shelter to survive, they guarantee the revenue floors of highly concentrated private monopolies. If the government directly handed billions of dollars to retail duopolies and commercial banks every month, the public backlash would be immediate. By routing this money through the citizen first, the state cleverly bypasses the political impossibility of a direct corporate bailout. Welfare is a highly efficient pipeline. It traps individuals in a state of dependency while guaranteeing the revenue floors and profit margins of the private sector. We look to the collect-levy profit equation. This macroeconomic identity establishes the foundation of corporate profitability. Profits, P, are the mathematical result of sectoral balances. The equation proves the government deficit, D, is a direct positive determinant of corporate profits. To understand why the deficit flows so cleanly to profit, we have to measure the marginal propensity to consume, the percentage of every new dollar a person immediately spends rather than saves. Because welfare recipients subsist below the poverty line, this is 100%. Their capacity for workers' savings, SW, is effectively zero. When the state issues fiat to fund welfare programs, the recipients must spend it instantly to survive. That capital flows symmetrically and entirely into the profit margins of the corporate sector. If the state were to enact austerity and remove the welfare floor, household dissaving would collapse. By strict mathematical necessity, aggregate corporate profits would violently contract. This flowchart traces a fiat dollar from state issuance to its final destination. In housing, the state injects fiat as rent assistance. The recipient transfers this to landlords. Ultimately, the capital flows to its final destination, the mortgage debt market and retail bank balance sheets. Banks face a structural vulnerability. They hold highly illiquid assets in the form of 30-year mortgages, but rely on short-term deposits they must pay out on demand. They need continuous, guaranteed cash flow to service that highly leveraged residential debt. The rent assistance payment acts as macroeconomic bypass surgery. The welfare recipient launders the state bailout through their biological need for shelter, securing the bank's localized asset risk. Without this constant injection of state fiat at the base level, mass landlord defaults would trigger a systemic liquidity crisis. The welfare state acts as a publicly funded insurance policy for retail bank solvency. We see the exact same architecture in baseline biological survival, where JobSeeker and the H pension fund basic food and necessities. For this pathway, the middle manager is Australia's highly concentrated retail grocery duopoly. The scale of capture is immense. These two supermarket chains absorb an estimated $754 to $887 million per fortnight of net state cash outlay. This bar chart tracks the retail duopoly's earnings before interest and taxes, or EBIT margins. It shows a clear, stepped expansion from 4.7% to 6.0% during the post-2020 period, a phenomenon known as seller's inflation. Because demand for food is inelastic, these monopolies execute an extraction squeeze. They accelerate the absorption of welfare injections simply by raising the prices of goods the public cannot refuse to buy. The fiat meant to sustain the biological life of the citizen is consumed entirely by the artificially expanded profit margins of the monopoly. This heat map demonstrates the thermodynamic velocity of money, contrasting bottom-up welfare with top-down subsidies. Injecting fiat into a population with a 100% marginal propensity to consume creates high kinetic transfer. The dollar rapidly changes hands, sustaining domestic supply chains. Conversely, top-down corporate tax cuts act as an adiabatic heat sink. The capital is instantly hoarded or parked in offshore accounts, stalling domestic economic velocity. The macroeconomic response to the COVID-19 pandemic provides a pristine historical precedent. This monitor displays a vertical spike in the effective unemployment rate during the crisis. The bottom-up coronavirus supplement, a direct welfare enhancement, kept millions out of poverty and sustained the foundational consumption required to keep the retail sector solvent. By contrast, this printed window notice asks about JobKeeper, a top-down corporate wage subsidy. Without clawback mechanisms, an estimated $20 billion of public money was transferred to corporate entities that actually saw increased profits during the pandemic. Utilizing the citizen as a biological conduit guarantees Fiat traverses the real economy. Direct, top-down corporate welfare bypasses the economy entirely, generating massive thermodynamic deadweight loss. This isometric diagram illustrates the structural pipeline. The state injects fiat at the base, the citizen is trapped as a conduit in the middle, and the corporate monopolies extract the yield at the bottom. Acknowledging this reality requires a total recalibration of how we manage inflation and monetary policy. When central banks deploy austerity measures or punitive rate hikes to combat inflation, they directly punish the biological conduit for price pressures generated entirely by the corporate middle manager extracting the subsidy. To prevent the collapse of the fiat regime, the state must engineer systemic feedback loops. If corporations extract the welfare subsidy, proportional corporate taxation is mathematically required to close the circuit and return that economic energy back to the state treasury. The welfare floor provides the absolute thermodynamic baseline required to prevent the mechanical heat death of late-stage financialized capitalism.